For some job seekers, August was not a good month. Hiring fell to the slowest pace in 8 months, and the previous estimate for June was revised lower by 28,000 jobs. But if financial markets were worried, it didn't show. After the initial disappointment, stocks returned to positive territory. And despite fewer jobs in manufacturing and a decline in retail employment, many analysts are taking the long view. Bankrate.com Bureau Chief Mark Hamrick believes the August job numbers are a seasonal blip. He spoke to VOA on Skype.
We've had a lot of other data points that have been pointing forward for the economy, and I think once we get past this 1 month report that we'll see an economy that's continuing to recover.
But the weak job numbers could give the central bank reason to pause. Wells Fargo chief economist John Sylvia says the Fed is less likely to raise interest rates soon.
It reinforces the Fed's view that they're going to be cautious with respect to changing policy. They will finish QE3 probably in October and November, but I don't think they're going to be all that anxious to be raising interest rates in the springtime as some people had expected.
Raising interest rates too soon could slow the recovery, just as business optimism is starting to grow. A new study by the American Institute of Certified Public Accountants shows 20% of businesses surveyed expect to hire more staff. But on Skype, AICPA Chair Valerie Rainey says that could change if the cost of doing business goes up too quickly.
And so when cost of capital goes up, that impacts people's desire or willingness to potentially invest, and they might be a little bit more cautious.
Seasonal aberration or not, U.S. unemployment fell 0.1% to 6.1%, likely because fewer people were looking for work. Arcega, VOA News, Washington.